This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to our daily roundup. We have a packed show today covering major shifts in global energy, high-stakes tech compensation, and the evolving landscape of artificial intelligence in academia and finance.
Iranian drones strike Kuwaiti oil plants before supply talks.
Leaked metadata reveals massive salaries for software engineers.
Oil prices swing wildly as Trump issues new threats.
Global allies scramble for a ceasefire as deadlines loom.
Gold and silver prices drop amid rising dollar strength.
Stanford's AI course features a legendary tech guest list.
A PR pro details the high cost of beauty.
Hedge funds use internal data to find an edge.
First, the Middle East. Iranian drones have launched a significant attack on Kuwait's oil infrastructure, causing what officials describe as severe material damage. This escalation occurred just hours before a critical OPEC Plus meeting where global suppliers were set to discuss increasing output. The Islamic Revolutionary Guard Corps claimed responsibility, stating they targeted petrochemical plants not just in Kuwait, but also in the United Arab Emirates and Bahrain. The Kuwait Petroleum Corporation reported fires at its Shuwaikik complex, which is the nerve center for the country's oil ministry. This isn't an isolated incident. It follows a pattern of Iranian retaliation against U.S. and Israeli military actions. With the Strait of Hormuz effectively closed by Tehran, the physical destruction of regional processing plants creates a double squeeze on global energy markets that could take years to fully repair, according to industry experts.
The timing of these strikes is particularly calculated, hitting right as OPEC Plus members were attempting to stabilize a market already reeling from the U.S.-Israel war on Iran. While the group agreed in principle to raise output by over 200,000 barrels a day in May, that move is largely symbolic if the oil cannot be safely shipped or processed. The damage to desalination plants and government offices in Kuwait further signals that Iran is willing to target the broader stability of its neighbors to exert pressure. Meanwhile, Donald Trump has issued an ultimatum, threatening to destroy vital Iranian infrastructure if a peace deal isn't reached within 48 hours. This cycle of strikes and counterstrikes, including Israel's recent hit on Iranian gas fields, suggests that the regional energy war is entering a much more destructive and prolonged phase.
Next, Meta's payroll secrets. New data has emerged, revealing the staggering salary ranges at Meta, providing a rare look into the compensation packages for the engineers and researchers building the metaverse and AI tools. At the top of the scale, software engineers can earn up to $450,000 in base salary alone. Even entry-level or mid-tier roles are highly lucrative, with front-end engineers starting around $178,000. The data shows that specialized roles, like ASIC and FPGA engineers who work on custom hardware, are commanding nearly $300,000. These figures highlight the intense competition for technical talent in Silicon Valley, where Meta is clearly willing to pay a massive premium to retain the people capable of maintaining its massive infrastructure and driving its future innovations in hardware and software design.
It is not just the individual contributors seeing these high numbers. Management roles at Meta are equally well compensated. A director of production engineering can earn over $350,000, while software engineering managers typically see ranges between $200,000 and $328,000. The hardware side is also seeing a boost, with senior staff hardware engineers earning nearly $300,000. These salary disclosures are particularly interesting given the broader tech industry's recent focus on efficiency and cost cutting. It seems that for core engineering and infrastructure roles, the downward pressure on wages hasn't quite hit home yet. For anyone looking to break into the field, these numbers serve as a benchmark for what the world's largest social media company considers the market rate for top-tier technical expertise in today's economy.
Now to oil markets. Oil prices are experiencing extreme volatility this week as investors react to conflicting signals of war and diplomacy. Brent crude spiked toward $112 per barrel following Donald Trump's threat to strike Iranian power plants and bridges if the Strait of Hormuz isn't reopened immediately. However, those gains were quickly erased as reports surfaced of a potential 45-day ceasefire plan being negotiated by the U.S., Iran, and various mediators. This whiplash in pricing reflects a market that is deeply desensitized but still vulnerable to sudden geopolitical shocks. In the U.S., the impact is already being felt at the pump, with gas prices exceeding $4 for the first time in years. The cost of jet fuel has also surged, forcing airlines to either cancel flights or pass the increased expenses directly to travelers through higher ticket prices.
Market strategists are suggesting that we might be entering a new kinetic equilibrium, where geopolitical friction becomes a constant background noise rather than a primary driver of long-term trends. Even with the Strait of Hormuz seeing a 90% drop in traffic, some investors are looking at historical precedents, like the pandemic and the war in Ukraine, noting that markets often bottom out before a crisis is officially resolved. The current situation is complicated by the fact that a fifth of the world's oil and liquefied natural gas passes through that narrow waterway. While there are early signs of some ship traffic returning with Iranian permission, the threat of U.S. strikes on Iranian infrastructure keeps the risk premium high. Investors are essentially caught between the hope of a diplomatic breakthrough and the reality of a conflict that has already fundamentally disrupted global trade routes.
Moving to ceasefire efforts. U.S. allies, including Pakistan, Egypt, and Turkey, are reportedly making a last-ditch effort to secure a ceasefire between the U.S., Israel, and Iran. The proposed 45-day pause is intended to prevent a massive escalation after President Trump set a new deadline for Tuesday evening. Trump's rhetoric has been blunt, threatening to destroy Iran's power plants and blow up everything if the Strait of Hormuz remains blocked. This deadline is the latest in a series of extensions since the conflict began in late February, which has already claimed thousands of lives, primarily in Iran and Lebanon. Despite the diplomatic pressure, Iran has officially rejected the latest ultimatum, insisting that it will only reopen the strategic waterway once it receives compensation for war damages. This stalemate keeps global markets on edge, as the window for a peaceful resolution appears to be closing rapidly.
While diplomats talk, the fighting on the ground continues unabated. Overnight, Iran launched multiple waves of missiles and drones targeting energy infrastructure in Kuwait and the United Arab Emirates. Israel also reported incoming fire, with emergency services recovering bodies from a home struck in Haifa. The UAE has issued multiple alerts as its air defenses work to intercept these persistent attacks. Interestingly, despite the blockade, about 15 ships were allowed to pass through the Strait of Hormuz in the last 24 hours with Iranian permission. This represents a tiny fraction of normal traffic, but suggests that Tehran is using its control of the waterway as a precise tool of leverage. As the Tuesday deadline approaches, the international community is watching to see if Trump will follow through on his threats or if the mediators can find a way to de-escalate.
Next, precious metals. Gold and silver prices have taken a hit as the U.S. dollar strengthens and investors digest the latest threats from the White House. Spot gold dropped over 1% to around $4,600 per ounce, while silver futures saw a significant decline. This downward movement is somewhat surprising given the geopolitical tension, which usually drives investors towards safe haven assets. However, the shift in market expectations regarding interest rates is playing a major role. Traders are now largely pricing out any possibility of rate cuts this year, a sharp reversal from the 2 cuts expected before the conflict began. The combination of a hawkish Federal Reserve and a surging dollar is creating a headwind for precious metals that is currently outweighing the fear of war. Analysts are advising investors to book profits on any price rises and wait for deeper corrections before buying.
Domestic markets in places like India are also seeing significant fluctuations, with gold falling below key psychological levels. Despite the current dip, some analysts believe that gold and silver will hold their support levels in the near term due to the ongoing volatility in crude oil and the dollar index. The physical market remains active, with standard gold prices in major cities like Delhi and Mumbai reflecting the global downward trend. For investors, the strategy seems to be one of caution. The heightened volatility means that prices could swing back quickly if the U.S.-Iran conflict takes another turn for the worse. For now, the focus is on the $4,500 level for gold and whether it can sustain its value as the global economic landscape continues to shift under the pressure of high energy costs and persistent geopolitical instability.
Now, Stanford's AI Summit. Stanford University has turned a standard computer science course into what looks like a major tech summit. The class, titled Frontier Systems, features a guest list that includes NVIDIA's Jensen Huang, OpenAI's Sam Altman, and Microsoft's Satya Nadella. This 10-week course focuses on the entire stack of AI infrastructure, from the physical chips to the final applications. What started 4 years ago as a small security class with 60 students has exploded into a 500-person lecture with a massive wait list. The professors, Michael Abbott and Anjane Midha, designed the curriculum to prepare students for a world where AI is a core component of every industry. By bringing in leaders from Google, Anthropic, and AMD, they are giving students direct access to the people currently shaping the future of technology and offering them unique leadership advice that goes beyond simple coding.
The course isn't just about listening to lectures. It challenges students to create and scale their own AI projects over the semester. The goal is to see how much value a single person can create using modern AI tools, reflecting the growing belief that a one-person billion-dollar company might soon be possible. This focus on AI natives is something tech leaders like Reddit's Steve Huffman have praised, noting that younger professionals who grow up with these tools have a distinct edge in the job market. Students have to submit their project proposals by the end of this week, setting the stage for a semester of high-intensity innovation. By centering the course on infrastructure, Stanford is ensuring its graduates understand the fundamental building blocks of the AI revolution, making them highly valuable to companies that are now requiring all staff to integrate these technologies into their daily operations.
Next, the beauty tax. A public relations agency owner in Utah is speaking out about the intense pressure to maintain a youthful appearance, revealing she spends $12,000 a year on beauty treatments. Hillary, writer, Azzaretti moved from New York City to Park City and found that the beauty standards in Utah were actually more demanding than in the fashion capital. She spends over $5,000 annually on her wardrobe alone, plus regular costs for Botox, manicures, and facials. In the PR industry, where you are often the face of your brand, there is an unspoken requirement to look fresh and polished. Azzaretti notes that in Utah, there is a heavy emphasis on longevity and wellness, with many people opting for hair extensions, plastic surgery, and laser treatments. This high cost of maintenance is seen as a necessary business expense to stay competitive and relevant in a superficial market.
The pressure isn't just coming from the outside. Much of it is self-induced as professionals strive to meet the perceived expectations of their clients and peers. Azzaretti explains that when she started her own agency at 34, the need to look the part became even more pressing. While New York is certainly focused on looks, she found Utah's culture to be more consistently beauty-centric across all aspects of life. This narrative highlights a broader trend where professional success is increasingly tied to physical appearance, especially in client-facing roles. For many women in high-pressure environments, these beauty routines are not just about vanity, but are viewed as essential tools for professional survival. The $12,000 annual price tag is a stark reminder of the hidden costs many people face to simply show up and be taken seriously in their chosen careers.
Finally, internal data edges. In the world of high finance, the next big advantage isn't coming from public markets, but from within a firm's own walls. Large language models have already scraped most of the public internet, making traditional alternative data like satellite imagery or credit card receipts a commodity that everyone can access. To find a true edge, asset managers like BlackRock and Balyasny are now turning their AI agents inward. They are searching through decades of their own internal research, past communications between professionals, and historical decision-making logs to find signals that competitors simply cannot see. BlackRock, which manages $14 trillion in assets, is already using these tools to structure their vast libraries of unstructured internal data. This shift marks a new era where a firm's historical institutional knowledge becomes its most valuable proprietary asset in an increasingly automated trading environment.
This move toward internal data mining is a response to the fact that AI has made public data too easy to analyze, stripping away the advantage that sophisticated funds once held. By tapping into their own massive data libraries, long-running firms can uncover unique insights that have been buried in old reports for years. Experts have long predicted that these funds might eventually sell their data, but for now, the focus is on using it to capture alpha. AI makes it significantly easier to process this information at scale, allowing quants to identify patterns in how the firm has successfully navigated past market cycles. As the competition for market-beating returns intensifies, the ability to effectively use private, internal information may be the only way for major hedge funds to stay ahead of the curve and justify their fees to investors.
That's our show for today. Thank you for listening to our daily briefing. We will be back tomorrow with more updates on the stories that matter most to you.